Some interesting IPO developments to talk about this week. China Juice Group Limited hopes to raise over $300 million in an IPO on the Hong Kong Exchange, the biggest IPO so far this year in Hong Kong. China Huiyan Juice is a subsidiary of Beijing Huiyan Beverage and Food Group, part of the Huiyan Group, and is part owned by French food and beverage giant Danone. Danone will pick up almost half the new shares offered in the IPO at a value estimated over $150 million US dollars in order to preserve its strategic investment in Huiyan of around 20 to 25% of the company. China's juice sector is growing at a rate over 12% annually, and Huiyan has over 40% of the market for the higher end products such as 100% juices. But the company imports over half its raw materials, including orange juice concentrate, and has little ultimate control over its costs. For its part, Group Danone is basing its future growth strategy on Asia and China in particular. Headquartered in Paris, Danone is probably best known for Evian water. The company opened a research center for dairy products in Shanghai in 2005 and has worked hard at adapting its brands for Chinese markets. There's a new IPO in the hot solar power sector. CEEG Nanjing PV Tech from Nanjing hopes to raise $200 million with the IPO on the big board in New York. The company is a joint venture between a Jiangsu province high-tech firm and an Australian research center. Australian concerns are making important investments in the solar sector right now in China. CEEG Nanjing will be the 7th Chinese solar power company to float before an IPO. It's an interesting group to watch. And some news of an older Chinese stock that has floundered since its debut. SMIC, Semiconductor Manufacturing International Corp. Of Shanghai, trades on the New York and Hong Kong exchanges. In New York as an ADR with symbol SMI. The stock and company has not performed well since its IPO in 2004. SMI says it is weighed down by an old, unprofitable operation in Tianjin, originally a Motorola investment. The company says it will now make some structural changes, including capping its capital expenses, and is considering a domestic IPO listing, a spin-off of its successful 300mm wafer plant in Beijing. So perhaps a turnaround is ahead. An industrial bank company limited of China made its domestic IPO on the Shanghai Exchange this week, offering over 1 billion A shares, which gained 48% on first trading, although it has declined since. The Fuzhou-based banking company says it will use the money raised to improve its capital adequacy ratio. The response shows that while investors may be looking more carefully at financial stocks in particular, faith in the market remains high. Finally, while the correction in Chinese stock markets may continue perhaps all year, we believe that the important thing to watch is how Chinese companies are returning to the mainland to raise capital. Right now, at least half the biggest and most capitalized companies in China are listed outside the country, mostly as H shares and red chips in Hong Kong. As these companies come back to the Chinese mainland, as they are already, China's market capitalization to GDP ratio will continue to rise towards developed market levels, and the Chinese stock markets, encouraged by government policies, will continue to grow.